Well, the U.S. Treasury repealed regulations that would have impacted the ability to generate discounts with the transfer of family-owned entities. Now it's worthwhile to revisit how entity structuring and the transfer of business can achieve valuation discounts and also save tax dollars. Joining us now for today's Rural Money segment is Roger McEowen with the Washburn University School of Law. Roger, as always, thanks for joining us today. So what would you say, of course, is the most common vehicle for any discounting?
Well, good morning, Janet. Good to be with you again. I think, frankly, the most common vehicle for discounting is what's known as the family limited partnership, also known as the limited liability company. They're really two different types of entities, but the same rules apply to each of those types of entities. And the principal objective of an FLP or an LLC in this instance would be to carry on a closely held business such as a farm or a ranch where management and control of the operation are really important. And so I think those are that's the most common vehicle for discounting.
So how can the valuation discounting, at least in the context of a family limited partnership, be used properly?
Well, let me give you the typical scenario, and I think this is very common when we're talking about ag businesses. You've got a parent, mom and dad, or one parent, if there's only one that's remaining, that own a family business, and so they establish an FLP with an interest of the general partnership totaling about 10% of the company's value, and then the limited partnership interest being the other 90%. And each year, both parents or the one parent give each child limited partnership shares with a market value that doesn't exceed the gift tax present interest annual exclusion, which is currently $15,000 per donee per year. And so in that way, over a period of time, the parents end up transferring business ownership to their children consistent with that present interest annual exclusion amount for gift tax purposes so that there's no gift tax, and they limit or eliminate estate taxes at death. So we're talking about people that have very large estates that are going to use this technique that need to transfer wealth to the next generation and do so in a manner that is tax friendly. And even if the kids together own 99% of the company, the general partner, the parents, still retain control, and the general partner is the only partnership interest with unlimited liability. And so it really satisfies a lot of intergenerational transfer goals of the family for these large-scale farming or ranching operations.
Now, Roger, are there any potential pitfalls?
Oh, yes. With any type of technique, there are all types of pitfalls. And, of course, the IRS has a lot of weapons in their bag of tricks that they can use. One of those in particular is what we call Section 2036 of the Code, and that is if you retain control over the assets that you transfer into the FLP, or you commingle your personal assets with the business assets, amongst other things that can go wrong. The IRS has got a good argument that you're not going to get any discounts on valuation for either gift or estate tax purposes, and those transferred assets are going to be included in your estate at death. That's bad on both counts, and we want to avoid that.
And Roger, do you have any insight from a succession planning perspective, since we also talk about that quite often?
Yeah, that kind of dovetails in with my opening comment. And another technique here is that both parents could make contributions to the partnership in the necessary amount so that one parent receives a 1% general partnership interest and the other parent gets a 99% limited partner interest. And if you hold the parent that holds the limited partner interest then could make gifts of that limited partnership interest to the kids. It's just kind of a variation on that initial technique. And the retained interest code section that I mentioned just a moment ago doesn't apply in that situation. And so you could have one spouse keep control of the business and the other spouse be the transferor, and we're not going to have assets pulled back into the estate.
Okay, well, Roger, thank you as always for your insight. Roger McEowen with the Washburn University School of Law joining us on the phone this morning from Topeka, Kansas.